Hello everyone. So today in this short video, we're going to be looking at the current individual tax rate structure and how it affects the planning for high earners. So we're going to also cover some capital gains and qualified dividends and highlight a few key strategies that we're discussing as CPAs and with our clients. Okay, so in this first one, this is the final 2025 is the final full year that we have the before key provisions from the Tax Cuts and Job Acts TCJA are set to expire. So right now the marginal tax rate is going to remain at 37%, that's the top marginal, which that applies to really those high income earners. So for single filers, that's going to be earners over 626,350. And for married filing joint, that's going to be 751,600. So these brackets are adjusted for inflation. They're going to increase every year. I'm going to post a link in the comments to the IRS website, which will give you the most current updated taxes rates for this. So we also have some capital gains rates. We've got 0%, 15%, 20, and what that is you have a preferred tax rate on any long-term capital gains, and qualified dividends are also included in those long-term capital gains. Now, if you're at the highest bracket, which is 20%, you might also be hit with a 3.8% net investment income tax as well, which really can raise that total tax on capital gains up to 23.8%. Okay. So we really have some planning that you can do with some timing and Roth conversion. So if you're looking at, you have a big capital gain coming up and you also, had the opportunity, maybe you can defer some of your other ordinary income into a future year or take it in this year so that next year you really have a lower amount of your income so that you have a lower tax rate. So you don't have to be at that 20%. You can go down to 15 or maybe even the 0%. For example, I have a client that I'm working with right now, retired client, and they're going to be selling their primary residence. So when they're selling their residence, there's a couple of other tax planning things we can get into later. But when you're selling your residence, and you lived in it for over a year, that would be a long-term capital gain. And there is an exclusion, but anything over that would still be a long-term capital gain. So he doesn't really want to pay any capital gains at all on the sale of his residence. And he can do that with the exclusion. And also, he's not going to take any of his retirement, any distributions from his retirement accounts. He's below the age, so he doesn't have any required minimum distributions. So he can really work on lowering his income in the year that he knows he's going to have a high capital gain so that he can be in that lower tax bracket. So that's when we talk about timing the income. There are things that we can do legally to play around so that you don't have to pay 1 cent more to the government than you're legally obligated to. All right, let's look again at some more of those capital gains and qualified dividends. So those thresholds for that rate, we saw that 0, 15, and 20, really is going to be based on your filing status, which is really depending on and your income. So that net investment income tax, I already talked about that a bit, but don't forget that depending on your income, you could be in a 3.8% additional tax. And so keep that in mind. And I already talked a little bit about some hold periods. If you're close to selling a gain, short-term capital gains are taxed at ordinary income rates, which means that you could be taxed at a 37% if you're in that highest bracket because you sold something before a year. But if you're in that long term, you have to hold it over a year, 366 days, then you get that long-term rate. So think about when you're going to sell an investment, what is the timing of that investment? How long have you held it? And then you also have the offsetting gains and losses. So you can offset a capital gain with a capital loss. So if you have maybe some securities that aren't worth so much, you don't think they're ever going to go up, but you also have a big planning opportunity, you could plan to sell one of those at a loss to offset that big gain as well. So lots of planning tips that we could potentially do here. So what's also changing in 2025? So while the rates are staying the same, it's still a 0%, 15%, and 20% on those capital gains, the income thresholds are going to be increasing slightly, which means that maybe some more of your gains could fall under that 0% and 15% rates. So you got also a little bit more room before you reach that top 20% bucket. So for instance, let's take a look at this filing status here. So we see that the 20% rate starts, if you're single, at $518,900, but that's for 2024. But in 2025, we see 533,401. So we've got more um, income that we can be selling before we get to that high rate. So I'm just going to do some quick math here. We're looking at about $15,000 more of income that we can have before we get to 20%. And if you're married filing jointly, you see it's about that same increase. So again, if you're planning to sell your investments or time your qualified dividends, you really need to know what is your bracket and for each year, and then time how much of that gain, if possible, that you're going to have within the same year, and that can really help you save some tax. All right, speaking of some more tax planning, we might want to recognize income of 2025 while rates are lower. Why am I saying rates are lower? Well, the TCJA Act, a lot of those are going to expire in 2025. This is the last year unless Congress does something. So the individual tax rates are going to go up if nothing is done. So right now it's at 37, but it can go up to over 39%. So we've got to think about that a little bit. If you're going to do Roth conversions, if the rates are lower now, might want to consider that, or maximizing some deductions as well before we have some potential changes coming up in the future.